Starting off another video. I want to thank y'all for tuning in to this video. And today we're going to be speaking about a subject that matters a lot to a lot of individuals, but most importantly, this subject helps build your financial future and can be the backbone towards your finances. So the topic for today is whole life insurance. And before we start, I got the websites if you need more information. Instagram, Brockett Financial Services. Facebook, Brockett Financial Services. I have a lot of YouTube videos on YouTube, C-Brockett Finance, and then the website is brockettfinancialservices.com. And we're speaking about whole life insurance today, so I'm going to just jump right into it and let you all know a little bit about it. So first and foremost, we all know what whole life insurance is. It's life insurance. And the whole life meaning that it covers you for the rest of your life. But there are some key things that you need to know about this policy that help y'all out drastically. I'm talking about, from the banking structure, saving funds, diversifying your assets, and things like that. It helps a lot. So I'm just going over the pros right now of the whole life insurance. It's a life coverage. What I said before, it covers you for the rest of your life. But we're going to go a little bit down. It's guaranteed growth. And I'm going to put a little star by this one right here, because this is a key factor that you all should look into. Now, we all know about life insurance and what it does, but we want to know more so about, what can we get out of it. And a lot of individuals think that, since you only have life insurance, your family only benefits from it, but it's a few different policies that you all need to know about that can help you out as well while you're still alive. And then the cash value, we're going to talk about that as well. Tax-free, that's another main point. And these are things that comes along with the whole life insurance. And then we got dividends. Another thing, set premiums is another one. So key takeaways that I wrote down already regarding this policy before we even dig down into it is it's about 3 to 5 more times more expensive than term insurance. Another one is good for people that are seeking a cash value. And the next thing is good for elders who do not have life insurance. These are, sometimes individuals who didn't think about life insurance, while they were young. So that's why I wrote those key 3 things right there. All right. And then, so here is a layout. And this layout presents a person age 30 as of right now. So in the age 30, the death benefit of the life insurance policy is $300,000, meaning that they will have the $300,000 covering their life for the rest of their life. So that's what we have right here. And as you can see, I just did this presentation up to age 55, and it covers the same death benefit for $300,000 for the rest of their life. So that's why it's a life coverage plan. So whatever you get with that life insurance policy, a whole life, your death benefit stays the same throughout the whole period of the time frame. Now, the key things what a lot of individuals want to know about is the cash value. Can I borrow from my policy? Does the money grow? Yes. And this one, I'm going to use this term. It's instead of the cash value, what I wrote down right here, we're talking about the infinite banking structure. And what I mean by the infinite banking structure is you basically gaining money, having your own bank account with this. So a key thing, you see the cash value, it grows over time. That's why we have tax-free cash value guaranteed growth. So the different things about this policy versus, let's say, a 401k IRA plan is that this faces no market risk. And what market risk is, for example, the pandemic happened, 401k drop, IRA drop, stocks drop, a whole life insurance policy won't drop because guess what? It's insurance first. So where this cash value benefit is coming from is the insurance company saying, okay, you're basically keeping your policy for a long time. You're spending a lot on this policy. So we're going to basically put some of your funds towards a cash value like your own bank account, and it's going to grow over time. But so what we're going to go into is this person is age 30. This is year 1. The annual premium is what I calculated is from an individual paying $200 a month. $200 a month. So say, for example, $200 each year, the premium remains the same. So we have right here set premium, so this is going to remain the same. So the first thing I have right here is age 30, 31, 32. And the only reason why I didn't do these in terms of 5 time periods is because I wanted to show you all the cash value of what you're thinking of or what you think you're going to get out of the policy and let you all know that it grows over time. So the first thing is that, let's say year 1, you pay $2,400 into this policy, the cash value is at $0. Now, this is you basically a time period of, the insurance company wants to make sure that you're going to have this policy for a little while before we offer you any cash value. Because guess what? The only thing the insurance company is doing, for example, is definitely investing these funds in the market so they can make money as well. But that's another story. So the second year, you put another $2,400 into this policy, and your cash value is $0. That's how it's going to be. So you know, for example, what you get a feeling for is that the more insurance you have, the higher your premium will be. So you're going to invest more money into it, and that would then fluctuate this type of sector. But this policy should only be started for individuals, you know, who already are, how should I say this? Individuals who have planned out their future, they have a term policy, they have stocks and everything else, and now they want a cash value policy to diversify their funds into a much safer thing, and they want to gain money off the cash value. But as you can see, at year 5, at 5 years into the policy, another year you put $2,400 in there again, your cash value grows to $3,600. Generally, what happens is that at year 15 or year 20 or so on, depending on the type of policy it is, the cash value will definitely be relative the same versus the money that you're going to put into the policy. But this one right here, since we did this policy in terms of the rest of your life, is going to continue to age 100, let's say. It will not compare to the amount that you put in at 15 years versus the 15 years of the cash value. It will not. Those are for different types of whole life policies that is generally the same type of whole life policy, but what happens is they have the amounts that you can pay in 10 years, 20 years, 30 years. Meaning that after 20 years of paying for the policy, the cash value will continue to grow, the death benefit stays the same, and you won't have to pay in the policy no more. This demonstration is based upon someone that will be paying $2,400 for that same policy for the rest of their life. So that's what we get into. So now that we have this demographic down, at the age of 45, 15 years into the policy, still paying $2,400 a month, the cash value is at $23,300. And at the age of 55, 25 years into the policy, still paying at $2,400 every year, is at $52,000. Now the good thing about this, being that you have that money, is that the cash value will continue to grow over the lifespan of the policy, always. Another thing is that this annual premium will be set. But what happens is, let's say for example, you're an individual at the age of 55 or whatnot, you have $52,000 in this policy as cash value, which is tax-free. So that's meaning that money that you take out of that policy, you're not taxed upon that in your taxes. That's just free money into your pockets. But the good thing about this is that you could take $30,000 out of this policy, but what happens is that you take some out of that cash value, it takes away from your death benefit. So at that stage, if let's say you take $30,000 outside of $300,000, your death benefit would not be $270,000. So that's the difference. But the reason why these policies are so good and beneficial is because if you're an individual at the age of 30, you had your first child, and now at the age of 55, your house is paid off, your child is grown, and they're more sufficient to do things on their own. You don't need the same $300,000 that you needed when you were younger. That child is now grown. You already done paid off your house. So you can start using this money for what? Retirement. Whenever you want to. Go on vacations, relax, pay your bills and everything. That's when you can start using this cash value. And it's going to keep growing and growing and growing over time. So the key takeaway, what you need to know about this is that the whole life insurance policy is guaranteed growth for the time period that you have the policy. The cash value is going to continue to grow. But just like I said, presented earlier, as soon as you start the policy, they're not going to give you that much cash value. Some companies have, give you something during the first year, depending on how much you invested in, probably like 5%. But over the duration of the policy, everything changes. It's guaranteed growth, guaranteed cash value. The cash value starts to grow. So now on the tax-free, you're not taxed on any money that you take outside of this cash value. But you always want to know that the more money that you take out of this policy, your cash value doesn't grow as fast as it should. So that's why you have to be very, on about how much you take outside of that policy. And we're going to say the same thing for under the dividends factor of this policy is that the insurance company, as long as you keep paying your premium, they're going to give you money from the policy. They're going to cut you, smaller checks from the policy. So that's why that dividend factor matters regarding this. But the whole thing regarding whole life insurance is to cover you for the rest of your life. Especially for individuals that are elderly that haven't gotten a term policy back in the day or haven't saved up sufficient amount of funds to cover funeral expenses. That's why, a whole life policy is very good. But if you're a young individual and you have already secured, your term insurance, you already have, good funds invested in the market, your 401k is doing good, you should definitely look at this. So some individuals go different routes in life, but a lot of individuals go toward the whole life insurance, and this is specifically, individuals like the pros, and I can tell you the pros on meaning that NBA players, NFL players, because a 401k, they can't input how much money they want to in there per year. IRA, the same thing. So what they do is that they get a big whole life insurance policy, let's say an amount of $5 million, $10 million, or whatnot. And of course, the annual premium is going to be more expensive during that year. But as they keep pulling big funds into this policy, it's going to grow. And let's say they get a $5 million policy, and a $5 million is going to grow, fast within this policy. So they will have life insurance, and it will keep growing. So even after they pay the policy for like 30 years or 20 years, in that nature, it's going to keep growing. So while they're alive, it's going to keep growing as well. So they can use those funds to cash value for anything that they want to. So that's why a lot of individuals get a whole life insurance policy, to tap into this cash value market, because a lot of people benefit that way, and you don't face any market risk. But remember, you do not control where your funds go within this policy. It's definitely up to the insurance company. So with that, whatever insurance company that you go to, you want to make sure that the cash value is growing good, and that you're going to see some returns back, because you don't want to be put into a policy that you're not benefiting from. So for just to start, back for those that are just getting into it, this policy about 3 to 5 more times more expensive than the term insurance policy. Good for people that are seeking the cash value sector of this, and it's good for elders who do not have life insurance. So for individuals, let's say at the age of 60, the family has a lifespan of about 85, 90 years. You want to make sure that you get a whole life insurance plan to make sure they cover that time frame, because term insurance won't cover 30 years at the age of 60, things like that. Or if you're an individual, that your parents just staying healthy, or they just have like slight minor, health problems, you want to make sure that you get a whole life insurance policy as well, because the individuals are living much, a different time period as of right now. So that's it for today. That's the whole life insurance sector. I just want to make sure that you all get that information. I will definitely be uploading this video to YouTube, so you all can go back and think about a couple things. So if you all didn't hear the beginning of the video, y'all can tune in on this. But once again, I just did this video on the first 3 years in the yearly period, so you can see like the cash value and how it grows during the first years, but it grows more down the timeline. And I can tell you just in general, this policy right here, like at the age of 70, this cash value will definitely be relatively the same versus the death benefit, and then it will continue to grow. So that's it for today, and make sure y'all share the video, make comments, and if you have any questions, leave the questions in the comments, and on the next video I'll circle back on them and get them to you all. So that's it for today, Brockett Financial Services.